Hello, we are live. It's Lex, and this is Options Brew TV, Traders Workshop. We're going to hit structured products today. Let's see what the guys have in store. Oh my God, it's the guys. What's up, boys?
Hello.
Come on, Lex. How you doing?
It's another balmy Thursday in Chicagoland. Just perfect. So going well. I need a big cup of coffee. I slept late today. I got to be honest. I woke up about 10 minutes to showtime.
You barely look it.
How can you tell?
You look the same.
I look the same. Like what's the guy from Back to the Future? The hair everywhere.
Oh, Doc Brown.
Doc Brown. Oh my God. How was the market last week for you guys? Anything good? Big updates. My goodness, right?
There were some serious updates, but then there was yesterday kind of seemed to usher in a little bit of a downtrend, I think. Anyway, I mean, when you get a three-quarter point drop in VIX, and you only muster 3-point gain in SPX. That's kind of that doesn't say too much for what the Fed did.
Yeah. So you don't get your happy beans that way.
No.
Okay.
Wait, that dot plot spooked a lot of people. I mean, we were down as much as 30 points at one point.
Something like that. Yeah. I think we were down 25 or something like that. But I think we're down 25 in the pre-market now too, aren't we? Something like that.
Oh, I didn't even look. I should probably do that, right? Would be
we're off 15 about 20 minutes ago.
15 SPU handles. Is that right?
Yeah, I see. Actually, now, futures are down 23. So.
Okay.
Ooh.
So where's our negative gamma cluster hanging? I like to use gamma. I know it's a Vanna thing, but where's that? They have a hard number anywhere on the SPX?
Hold on, I can look and tell you where gamma starts. Hold on, I'm looking at Volin now.
Okay.
Well, we're at that half of the quarter where we spend the rest of the time talking about the JP Morgan strike, and that's sitting right around here, right? What is that, 43.60?
Yeah.
You have that, right, Jason?
Yeah. The 43.20 is the JP Morgan strike, and then the put strikes are like 38.85, and somewhere even further down below that is
that's pretty far though from where we are though, right?
Yeah, I mean, typically a lot of people like to say that that will pin to either the bought put or the bought call, which kind of talks more about Vanna, but I don't know. This time, I think I don't think we're going to pin there at the 43.20 area. Okay. I mean, we're looking down now, and really volatility is due for a spike. By the way, if you're looking for that kind of negative gamma, we're actually kind of. I mean, there's a lot of puts that were bought beforehand, so around like 4,300 is when you start seeing some serious selling.
40. You said 4,300.
Yeah.
Okay. Got it. Maximum pain.
Yeah.
Remember that? Maximum pain.
Maximum pain.
Interesting. All right. We'll keep an eye on that. So, Mark, we kind of teed up structured products at the end of last week, right? And I was saying I have a really good colleague and friend who runs a big structured products place. So let's tackle that one today. What do you say? See what we can come up with relative to structured products. So these are, I know we don't offer them at Tradier yet. I think it's a little funky for us at this juncture, but maybe you can just kind of give us an idea what the structured product actually does. How does it walk, talk, and quack?
Like a duck. So structured products, I mean, and they're particularly interesting in this environment, not because it's low volatility necessarily. That does make certain types of structured products interesting. But the interest rates definitely add a lot of juice to them. So at a really high level, a structured note or a structured product is something that's issued. They're typically issued by like a bank. And but you can create your own in the options markets because their payoffs tend to look very similar to what you can get with a combination of option spreads. And the whole idea behind them is to give a sort of defined outcome type investment, that if the SPX does X, you get Y. If the SPX does Y, you get Z. And it sounds a lot like options, of course. But they're typically sold to investors. You need to be at a certain, access point. They're, often in large denominations. But they're meant to be like an investment package with a defined payoff, like I said.
Okay, so it's more of an interest rate product, you'd say? Is that kind of the idea? You're looking for a certain return, and the product structured so that you get that, should that event occur?
Correct. It can be based on an index. It can be based on a basket of stocks. There are all kinds of different ones that your payoff depends on the best performing asset in a basket of stocks, or on the worst performing, or do you have a hard cap at this level or a soft cap? Like a soft cap is more like a put spread where you're covered for a certain percentage. Hard would be just the same as owning like a long put. But the interest rate comes in because one of the simplest structured products that I like to think of and that I actually use for some of my clients is the long T-bill, long call spread, long put spread, or long call. So if you buy zero coupon bond, you use the difference between the principal and the amount you paid and invest that in options. So you have a defined outcome that you're guaranteed to get X at the end of that period, but then you get this little kicker with your call spread, put spread to the downside if that's what you want. You could do 80% of a call spread, or 80% of a bond and be guaranteed that percent of a return and have more call spreads that you buy on the upside. So there's a lot of customization you can do there.
Yeah. So does the structured product, does it have a typical expiration? How does that work? The expiry part of it?
I believe in their like classic form, the way they're sold by the banks and traded on a platform like Halo, is that they have typically a year plus in maturity. That they're generally like medium to long-term dated setups. But you could buy a 30-day bill and a couple calls on the S&P 500, in your own account for as short a time as you want it.
Right. So what's the big advantage to trading these? I mean, did they trade on an exchange? I got introduced to these maybe a couple of years ago, but again, I said it didn't fit our offering very well, but maybe it does. The more I think about it, how do they trade? Is it like a what do you call it? A phone dial sort of heavy lift kind of a trade, or is there an exchange I can go to? What does it do?
So I think for the most part, that's the big thing about them is that they don't trade. That they're typically issued by the issuer, by Barclays or whoever, JP Morgan, is also a big issuer of them. And you buy that note, and it's a debt. It's like it's a note against that bank, and there is no real secondary market for them. The bank can come back and buy it back, for a major discount and whatnot, but they're not typically like tradable in any secondary market.
So it's not a super retail sort of product.
No, but the reason they're very desirable to like high net worth investors is because of that defined outcome. And like a retail investor can very easily create that same setup. There are some exotics, of course, that you can't, but like most of the vanilla structured product setups, you can build for yourself in options. That's like what an options overlay is.
Yeah. So, and you mentioned the other, at the end of the last show that you were able to maybe take a gander at SPX out in term to get a feel for how SPX would behave relative to the structured product in terms of what kind of interest rate coupon that could be, right?
Yeah, so I got a question from someone about a structured product that I think it was more theoretical than something they were actually being offered because it sounds too good to be true. But the typical setup is something like, would you rather have the returns of the SPX over the next 5 years, the absolute uncapped returns of the SPX with 20% of your capital at risk, so you bear the first 20% of your downside? Or would you rather get only the first 70% of the returns in the SPX? So if SPX is up 69%, you get 69. If it's up 71, you get 70. If it's up 12, you get 12. would you rather have that, but with a complete zero downside? So your principal is totally protected.
I don't know. It sounds like I want to have that second one.
So you want the full protection, but you can't make more than 70% over the next 5 years.
That's a lot.
Yeah, that seems pretty good.
I think I like that one. I don't know.
Right? 70% is like 11.5% compounded, or maybe 11% compounded.
Yeah. How
That's pretty good.
That's pretty good.
Yeah. How's the other side making money on that?
That's what I want. That was my next question. Thanks for intercepting that one, Jason.
Totally. That's why I think this is just a theoretical example that someone posed. It's much fun for the thought experiment that, like, you have to give up some downside to be able to get that basically market mean return for free.
Yeah.
Right. That doesn't make sense to me, that metric. Or I know you were just pulling these out, but that seems like a bad sale from the dealer side of that one.
What you're basically selling is a far out of the money call. And if you think about, the distribution of returns over the last 5 years, how often is the market down more than is down, period, over a 5-year period?
Right. It's just that when it is, it's pretty, the velocity is pretty great. But I guess it doesn't matter.
Yeah,
Product.
Yeah, but if you're selling a call and the market goes down, you have downside on that.
Yeah.
Right?
Limited, but yes.
Yeah.
You don't use these, Jason, I can tell.
No.
How come? Why don't you like them?
Because I don't have enough money. But the thing is that
I don't believe that.
Yeah, I mean, although the thing is I think if you get, if there's like a list or some kind of thing of structured product, you could figure out ways to hedge that and make money on it.
Well, that's what the bank is typically doing on the other side, right? Is that they're short that risk to you and they're hedging it out on their own, whether it's in, swaps or in the listed options markets. To give you an idea, though, going out 5 years, so we can go out like 4.5 years in the SPX right now. So they're like December 2027 leaps that are out there.
Mm-hmm.
If you want zero downside, so buying the 4,300 put in SPX or something like that, they're only listed every 100 points out that far. But if you want zero downside, the upside call you're going to sell, I forget the exact number, it was in like the 52 or 5,300 range. So
about 100 points from where we are. Is that right?
Yeah, less. I think it was maybe only like 80 points from where we are.
Got it.
So like you do get some upside, but actually no, it's closer to like 20% upside, 5,200.
Okay.
Yeah, 5,200. That's 800 points, 850 points of upside. These numbers are like a couple days stale, but
go ahead. Sorry.
Big picture, right? If you want perfect downside, you can only get up to 20% on the upside for 5 years. It's about the risk-free rate.
Okay.
Slightly less.
Okay.
Sorry.
Sounds like one of those like variable equity annuities, except with them you have to pay all these huge fees. So you have like this implicit, you have like this third downside that people don't pay attention to. It's like, oh, I'm paying this big fee, but I have no downside. Well, yeah, your fee is your downside.
Yeah, right.
Which is guaranteed.
Okay, so
yeah, guaranteed downside.
So, Mark, you can lock in, just so I understand, with SPX, you can lock in roughly 20%. Is that what you were indicating?
Money won't, that like you're locked in at this, asset level, and you get up to 20% upside.
I gotcha. Okay. Got you. So that's kind of like is that what do you call it? A risk-free collar of some kind that you would do? Not a risk-free, but a no cost collar.
Exactly. It's a zero cost collar that's skewed because of the risk-free interest rate and the upside, the vol on it.
Right. Okay. Interesting. So you can create these yourself is the takeaway, if you'd like.
Yeah, I think it's a really interesting way for people to frame like an investment in something, right? But if the reason they're saleable to people is because it's a really simple framework. Say, I can make X, I won't lose Y, boom, I can sleep with that, rather than just this unbounded volatility. And so, like, if that's something that's desirable, and we're talking about the JP Morgan trade, reason like volatility buffering strategies are popular is because they add a very distinct element of, defined outcome to, your portfolio.
Right.
So
yeah, that's
you can
interesting.
create it at any level you want on any equity you want. Beauty of these options markets.
Right. So someone asked me this question the other day too, and I think it's around this whole structure. Well, if you're just looking to generate income on your portfolio of stocks, what's the best way to do it? I think you kind of just answered it, right?
Sell your stocks and buy bonds.
Yeah, I was about to say bonds.
That's getting close to being true. With where the bond market is, right?
Yeah, I mean, I only say that like 10% jokingly.
Yeah, well, 10% more of where it is, right? And then you're absolutely trying to. I'm agreeing with you. I think.
Yeah, it's funny because it's true.
What number percent wise where you just say that for real? I mean, I gotta believe if I invested money 100 years ago with my manager and he returned on average 8% over that period, I would be extremely happy. Is that accurate-ish?
Right. So if that's your 100-year with volatility value, with equity risk premium value, how much are you willing to give up for certainty at any moment? I mean, it's not perfectly certain, as we've seen with some of these banks' balance sheets. What the value of your bond is worth, but like, there's a lot to be said for certainty, and maybe it is only 1 or 2 percentage points.
Yeah. So if you could get, I mean, God, you guys don't remember this, you're not old enough, but in the 80s, the 1980s, interest rates were like crazy high. And I knew guys who traded at the Board of Trade who made a ton of money and they quit and virtually put it into, 30-year bonds at some crazy number, 18% or something like that. I'm like, seems good, except when the 30 years goes by and then now you got to reinvest. But God, I 30 years now, I'm good.
Yeah, no, I think the calculus is rapidly changing.
Yeah, God, that's
not been that way for 15 years.
That's something. Well, you can't. I mean, 30-year note right now is what, or 30-year bond. What is it?
Still like 2% or something like that.
Yeah, I mean, we're not even close.
Yeah,
but
which is actually kind of funny because yesterday bonds rallied, even though the Fed was talking about, they raised their dot plots, and somehow bonds rallied. Bonds are spitting in the face of Powell every month.
Yeah,
he doesn't like that.
No,
we're getting Fed hikes next month.
Yeah, I found out that the money market's paying around 5%. That was good. That's good news. 5%. I'm almost there. I'm getting close.
Yeah.
I mean,
it's only good for, was that a 30-day rate or is that a year rate?
I forget. I think it's 30.
It's like 2.
2 year?
2, I think, is up to 5.25, isn't it?
It might be.
The govies are. Yeah, I think so.
Yeah.
All right. Oh, jeez. Okay, I got some things to do this afternoon then, don't I?
Oh, in the last year, I bought my first bond ever.
Is that right?
Yeah, the last like 6 months. No, maybe 8 months.
That's awesome. All right. Anything else? I know. You know what I find is that I find the market to be kind of boring, honestly. I know it's up, it's down big. I think this is kind of boring. There's nothing. There's no newness to me of late. I don't know if you feel the same way. I just feel like it's a blah trading environment, especially with low volatility. Lower.
You got highway vision from the last 3 years.
I know. I get COVID vision. It never went away.
Well, I think the other thing too is there is a lot of anticipation of something happening, but until it happens, I think it's nothing. When the bank crisis happened and there was a ton of hedging, it was the only VIX vol event that we've had in the past 3 years, and there was a bunch of hedges showing up on Voland, and they're now getting ready to expire between June and September. Those are the two big chunks that they hedged. So
And they're not repositioning it.
Not yet. I mean, there's some, but not yet. So you might get your share of fireworks.
Yeah. Okay. Interesting. Yeah.
Keep quiet, Lex. I'm like in placid waters here.
Uh-oh. You're happy?
Yeah.
Okay. Yeah. Okay. Yeah. I'm still living.
I'm happy.
I'm still living my dream of chaos in the markets. So, when I was a floor trader, that's always more fun.
That's always way more fun.
All right.
Yeah.
What's that?
For the business of trading, that's great.
Oh yeah, without a doubt. Without a doubt. Okay. Any other hot buttons that you guys are looking at right now in the markets? Anything standing out unusually? I haven't seen much. I really haven't. I got to be honest. It's been, like I said, a little bit of a summer yawner.
I mean, I think when you're looking back, it was a yawner, but when you're looking forward and you kind of, these growth metrics are still kind of shaky. Every time an employment report comes out, you think, it always seems to overshoot to the upside. But when the KC Fed employment index comes out, it always undershoots. So you don't know what's going on over there. And I don't know. There's a lot of like tremors that I have my eye on, but it's not reflecting in really any market right now. So,
Right. I'm looking at the futures here real quick. I see down 14 pre-market. I only have a little pre-market left.
Oh, it bounced then.
Yeah. Option volume still outstanding though. I will say that. I think I looked OCC composite yesterday was like 50 million with a 2023 average of about 44, give or take. So that's pretty good. And I think yesterday, what are we in, Thursday? So a Wednesday is a typically lower day volume wise.
Well, yesterday was FOMC though. So
yeah. And people before that comes out, people wait and they hang and sit on their hands, and now it's out. So I expect to see, all things being equal with the market, what they do, pretty good volume these next couple of days. Expiration, obviously, Fridays are nuts. So I think that will probably be pretty interesting. I like to see the volume.
How much market share does Tradier have of all those options?
Probably in the 1%. I mean, we look at it in terms of retail flow, though. What percent of retail? So, hey, Wiz, you're getting a question. What?
I get a question.
You mentioned some hedging was added. Is that for July OPEX or later?
Yes.
Yes. What?
Both. I mean, most of it was July. But yeah, I mean, there's right now if you're just talking about put Vanna, because the other thing too is a lot of calls were sold back last week. We saw the markets going up as implied volatility was going up, and we were seeing calls being bought and sold, and you saw that the positive correlation for a little while of VIX and SPX. So I think so. There was some hedging, but it was mostly sold calls, and then there were bought calls also on the outside of that. So it's kind of it's a little bit different. There's not many puts being bought, so it's bad hedging.
Okay. Wait, not many puts being bought. That means we could go down. All right, sounds good. All good. I think we're running out of time, boys. Good to see you, Mark. I know you're coming home. I can see boxes getting ready to be packed.
Oh yeah, they're somewhere. Actually, I sent my first bag back yesterday, so we're making moves.
You're making moves?
Oh yeah.
Just make sure there's no classified documents in your boxes in the bathroom.
Yeah, we'll get him at the border.
Get those out of there first.
Mark and I are gonna crack open one hell of a bottle when he gets back in town. I'll tell you that right now.
I'll bring you back something special.
I love it. All right, guys. Well, good to see you. We'll talk next week. And you guys, happy trading, right?
Yeah, happy trading.
All right.